Hi and welcome to part 2 of employee stock options or stock options for a US company. If you haven't watched our part 1, I do recommend to go ahead and watch that first before watching this so that you get an end-to-end experience about what are the various options available. Now let's look at something called restricted stocks or RS, or it's also called RSAs, restricted stock awards. In this, you get restricted stocks on day one itself and you don't pay anything for this. Generally, it comes as part of your compensation package. So you don't purchase them, they are just awarded to you. Since this is already a stock which has been awarded to you, there is no exercise process which is involved in this. So as it gets vested, the restrictions are lifted and you are eligible to sell them as unrestricted. Again, being an unlisted company, the overall ceiling on taking a company approval and all would apply, but then it really becomes your stocks only after vesting. So as we discussed earlier, right, when you get vested, so you end up paying income tax on the spread of the grant value and the fair market value on the date of exercise. In this case also the same is applicable. Like on vesting, whatever is the fair market value, since it is automatically vested, at that time you are eligible to pay tax on that spread. So for example, after year 1, if you have like the fair market value is $15 and at grant it was $5, and if 1000 options are getting vested on year 1, then you are getting a spread of $10,000. So you will end up paying an income tax on this $10,000, and whenever you sell it, then you will end up paying a capital gains. So for restricted stocks, the employee may choose actually to elect for section 83B. Now what is this 83B? 83B allows you to pay a tax on the date of grant, like within 30 days you have to select for it. You can choose to pay taxes on $5,000. Say you got 10,000 options for 4 years. The only catch is you have to pay on the entire 10,000, not for 1 year or 2 years of vesting. So whatever award you are getting, if it is 10,000 options and if they are valued at $5, so you may choose to pay a tax on $50,000, which is the fair market value on the date of grant. Now there are good things about it and bad things about it. The good thing is, as it gets vested, then you don't end up paying a tax at that time. You will end up paying tax only when you sell the shares. So whatever is the difference between say $50 you sold and 10,000 options, that is like $500,000, and you paid $50,000, so you will pay capital gains on $450,000. Every year as it gets vested, you don't end up paying a tax on it. The challenge is, or the downside is, suppose you quit the company after 1 year. So technically say 2,500 stock options got vested, the balance 7,500 stocks got forfeited, but you have already paid a tax on $50,000. So the IRS has not defined any mechanism to get that tax credit back. All you can do is you can just write off that. So you have to see whether you would be continuing before making an 83B election. So these are few factors that you should consider. One, you are really determined to be working with the company for the whole vesting cycle. Second, you also expect the stock prices to go up, because even if it goes down, the stock prices, you are not going to get a refund because you have already paid taxes in the date of grant. That money cannot come back. So these are some of the downsides that you should look. If you plan to leave the company, the unvested portion, there is no tax refund gonna come back. And if there is a downside to the stock, then also you will not get any money back. So these are few things that you should consider while seeing what is the best stock option. It's a great tool for them to retain talent, because they know if the employee leaves in between and if unvested stocks are there, then they lose out in it. So it gives an extra motivation for them to continue working for the organization. Now let's look at another stock options called RSUs or restricted stock units. These are also typically offered free of cost, and this is not very popular with startups and typically used majorly by larger enterprises or listed companies, where employees have a visibility that they would be able to sell the stock soon as it gets vested. Now the challenge is, since it comes free of cost, you don't have to do any specific exercise around it. So as soon as you complete your vesting milestone, the stock should get allocated to you. Now whatever is the fair market value on the day of your vesting, that becomes your income because you have got them for free. So the whole fair market value becomes your income and you end up paying a tax on it. Now the company may choose to sell some of your stock unit and pay for tax, or you have to pay the taxes before you get these stocks. So that's the challenge, and that's why it's not very popular with startups, because employees cannot really afford to give so huge taxes without a clear visibility when you would be able to sell them. And after allotment, whenever you sell it, you again end up paying a capital gains on the sale value minus the vested fair market value. So that's majorly about RSUs. Now let's look at new type of instrument. It's called stock appreciation right. So these are basically you don't get actual options to buy stocks, rather the date of grant. You know what is the fair market value that is written on your grant letter, and whenever you exercise it post vesting, whatever is the fair market value, you would be given the difference of the amount as cash payout. So this instrument is majorly defined for giving you a cash payout, not for stocks. But if the company has it in their policy, they can also reward you instead of cash in stocks. So basically, let's look at an example. Say you got 1,000 SARs, which was at $5 value from the date of grant. And when you are exercising it, it's of $15 value. So if you are exercising all the 1,000 options which is vested, then you are eligible to get $10,000, which is the spread difference of grant FMV and the exercise FMV as cash payout. Now if your SAR policy support that you can also convert it into stocks, then you can actually get stocks against it, but you will get stocks at $15 value. That means $10,000 worth of stocks divided by 15, which is somewhere about 660 or 666 stocks you should get. So that's where you can see the difference. Since you are not getting the complete upside, it's only the appreciation from $5 to $15, whatever that spread is. Either you can take it in cash, or if you want to convert it in stocks, you will get $10,000 worth of stocks, not $15,000 worth of stocks. That's where the difference is. If you are taking the money in cash, the $10,000 becomes your normal income and you end up paying an income tax on it. Since there is no stocks available here, so that's the all income tax you pay. There is no capital gains because you never got the stocks. And if you choose to take them as stocks, then it actually becomes your cost of buying, and when you are selling, you will end up paying a capital gains on the difference. SARs typically are designed to promote cash payouts rather than stock payouts. Now let's look at one more item which is called phantom stocks. So phantom stocks are designed to mirror the original stock, but since this is phantom, you never get a stock. So it is something similar to SAR that way. The major difference is instead of getting just the appreciation, you are actually promised a full value of the stock. So let's look at it how it works. $5 was the phantom stocks when it was granted, and say you were granted 1,000 phantom stocks which got vested and you are now exercising it, and at the time of exercise the value is $15. Again, this is also designed majorly for cash payout, but few phantom stocks could also support payout in stocks. So if you are getting cash payout, then on the date of exercise you will get $15,000, because irrespective of the grant date FMV, you were promised 1,000 phantom stocks which were valued at $5 that day, but you have not been promised an appreciation right. It is a full stock which is a mirrored stock which has been promised. So 1,000 stocks were promised and the value of 1,000 stocks is $15 per stock, total $15,000. That becomes your income and you end up paying an income tax on it. Now if you have chosen to exercise this $15,000 into stocks, $15 was the price of stock that day, so you will end up getting 1,000 stocks again on that day. And whenever you sell those stocks, then capital gains would apply. So that's majorly the difference between phantom stocks and SAR. Another difference is phantom stocks is a mirror of original stocks. If you don't get the real stocks, you don't get any rights associated with the stocks. Dividend may still be given if the company plan supports, but majorly the voting rights are not given till the time you actually hold the real stocks. So that's another difference that you should be aware about phantom stocks. That's all in various types of stock options. There is another type which is called ESPP, Employee Stock Purchase Plan, but again that is more applicable for larger entities or listed entities where they open a small windows where employees can buy eligible number of stocks for a discounted price, typically 10 to 15 or 20% discount. So the idea is to promote short-term gains. So you buy it at a 15-20% discount, and maybe if you want you can sell it immediately and make some 15-20% money. Or if you want you can continue to hold if you believe the stocks will continue to go up. But this is not popular in startup ecosystem. This is again majorly associated with the larger or listed companies. So that's majorly about various stock options that is available. Just to have a quick recap, there is ISOs, which is incentive stock options, which is applicable only to employees. Then there is NSOs, which is non-qualified stock option, which is applicable to almost all kind of stockholders. This is also the most popular way of giving grants to various stakeholders. Then you have restricted stocks, which is like you get stocks on day one and there are restrictions associated with it. As you vest, the restrictions gets lifted. Then there is restricted stock units, RSUs. Restricted stocks and RSUs both comes free of cost. So RSUs also is more prevalent with larger companies. As you vest, there is no exercise applicable, so you end up paying tax as soon as there is a vesting happens, both in restricted stocks and in RSUs. Then you have SARs, which is stock appreciation rights. This is designed majorly for cash payouts and you only get the benefit of stock appreciation. If the stock appreciates, whatever is the difference, that is the money that you get. And then there are phantom stocks, which is actually the whole stock, but this is also a cash payout thing. So whatever stocks the fair market value of, whenever you exercise, you get that much money in cash payout. I hope you have enjoyed this and you have got to learn. These are the most commonly used stock option instruments for a US company. So while designing your ESOP strategy, you can have a mix of all kind of instrument. You can have a mix of few of them depending on what the company goals are, what kind of employees you are trying to retain and hire, and that's how you go about designing it. Thank you so much and take care.